3 words explain how billionaires pay almost zero in taxes while accumulating more wealth than most countries. Buy, borrow, die. This isn't tax evasion. It's perfectly legal tax avoidance using mechanisms written into the U.S. tax code. Elon Musk, Jeff Bezos, Warren Buffett, and thousands of wealthy individuals use this strategy to live lavishly while reporting minimal taxable income. The mechanics are simple, but the implications are profound for inequality, government revenue, and the social contract. Buy means acquiring appreciating assets, usually stocks in companies you control or have significant stakes in, and holding them indefinitely. Don't sell. Selling triggers. Capital gains tax. As long as you hold, gains are unrealized and untaxed. Your net worth increases by billions, but you report zero income from those gains. Borrow means using those appreciated assets as collateral to take out loans. Loan proceeds aren't income, so they're not taxed. You spend borrowed money to fund your lifestyle, houses, jets, yachts, whatever you want. Die means passing those assets to heirs who receive them at a stepped-up basis. The cost basis resets to the market value at death, eliminating all unrealized gains. Your heirs can sell immediately with zero capital gains tax. This is the story of how the U.S. tax system allows the wealthiest individuals to avoid taxation on their primary source of wealth, asset appreciation, by never selling. How borrowing against assets creates tax-free cash flow, how the step-up basis at death erases generational tax obligations, and how this legal structure contributes to wealth concentration, fiscal deficits, and a two-tiered tax system where wage earners pay rates the wealthy avoid. Understanding buy-borrow. Die matters because it reveals the fundamental asymmetry in how wealth and income are taxed. If you earn wages, you pay taxes immediately, withheld from your paycheck before you see it. If you build wealth through asset appreciation, you can defer taxes indefinitely and potentially eliminate them entirely through death. This isn't a loophole someone discovered. It's how the system was designed. Changing it would require rethinking basic principles of taxation, wealth, and fairness. The buy strategy starts with acquiring assets that appreciate. For billionaires, this usually means company stock. Elon Musk owns Tesla and SpaceX shares. Jeff Bezos owns Amazon shares. Mark Zuckerberg owns Meta shares. These holdings represent their primary wealth. As company valuations rise, their net worth increases. But they don't sell the stock, so they don't realize gains or pay capital gains tax. The numbers are staggering. Elon Musk's net worth fluctuates between $200 to $300 billion depending on Tesla's stock price. Almost all of this wealth is unrealized gains in Tesla stock. If Musk sold $50 billion of Tesla stock, he'd owe roughly $10 billion in federal capital gains tax at the 20% rate, plus 3.8% net investment income tax, plus California state taxes if applicable. Total tax burden could approach $13 to $15 billion, so he doesn't sell. Jeff Bezos faced a similar calculation when Amazon stock appreciated from pennies to over $3,000 per share before splits. His Amazon holdings represented over $100 billion in unrealized gains at peak. Selling would trigger massive tax bills. Instead, he held the stock and borrowed against it when he needed cash. Warren Buffett has built Berkshire Hathaway over decades, accumulating unrealized gains of over $100 billion in his personal holdings. He sold minimal amounts, preferring to hold and let gains compound untaxed. The tax code creates this incentive structure. Realized capital gains are taxed, unrealized gains are not. This makes sense for most people. You shouldn't pay tax on a house's value increase until you sell. But for billionaires with most wealth in stock, it creates a permanent deferral mechanism. Holding assets indefinitely means never paying capital gains tax during your lifetime. The psychological and practical incentives align. Selling triggers taxes and reduces ownership stake. Holding preserves control and defers taxes. For founders and major shareholders, maintaining ownership often matters more than liquidity. Elon Musk's influence over Tesla comes from his ownership stake. Selling reduces that influence. Bezos's Amazon stake gave him control over company direction. Zuckerberg's Meta holdings ensure he controls the company despite pressure from other shareholders. But holding creates a problem. How do you spend money if you don't sell? This is where borrow comes in. Wealthy individuals take loans using their stock as collateral. Banks eagerly lend to billionaires at low interest rates, often 2 to 4% annually, because the loans are secured by liquid, valuable assets. The bank knows that if the borrower defaults, they can seize and sell the collateral. The mechanics are straightforward. Elon Musk wants to buy a $100 million estate, but doesn't want to sell Tesla stock and pay $20 to $25 million in taxes. Instead, he pledges $150 million of Tesla stock as collateral and borrows $100 million from a bank at 3% interest. He now has $100 million in cash to spend. The loan proceeds aren't considered income, so there's no tax due. He pays $3 million annually in interest, which is often tax deductible. The Tesla stock remains his, continues to appreciate, and he retains voting rights. This strategy scales indefinitely. Need another $50 million? Borrow it. Tesla stock went up. Now your collateral is worth more, so you can borrow even larger amounts. The loan-to-value ratio typically allows borrowing up to 30 to 50% of the collateral value. With billions in stock holdings, you can borrow hundreds of millions or even billions while never selling and never paying capital gains tax. Real examples demonstrate the scale. In 2020, Elon Musk took out personal loans exceeding $500 million using Tesla stock as collateral. He used this borrowed money for personal expenses, investments, and SpaceX funding. The interest was low, around 3%, and the alternative would have been selling stock and paying 25% plus in taxes. The math is obvious. Borrow at 3%, avoid taxes at 25%. You're 22 percentage points better off. The specific mechanics of these loans matter. When Musk borrowed $500 million, he likely pledged around $750 million to $1 billion in Tesla stock as collateral, depending on the loan-to-value ratio the bank required. At 3% interest, he pays $15 million annually. If he had instead sold $500 million of Tesla stock to get that same cash, he would have paid roughly $125 million in taxes on the embedded gains. By borrowing instead of selling, he saved $110 million in taxes in exchange for paying $15 million per year in interest. The borrowed money can be used for anything: buying real estate, funding other business ventures, personal expenses, investment in private companies. The flexibility is total because loan proceeds aren't restricted. Banks don't care what you spend borrowed money on as long as you maintain the collateral value and make interest payments. If the stock price drops significantly, banks may issue a margin call, demanding additional collateral or partial loan repayment. But for billionaires with diversified holdings, meeting margin calls is manageable. They can pledge additional assets or sell small amounts to satisfy the bank. The 2022 Twitter acquisition by Elon Musk involved complex financing, including loans secured by Tesla stock, demonstrating how borrowed funds can finance multi-billion-dollar transactions without selling equity positions. Larry Ellison, Oracle founder, reportedly has borrowed billions against his Oracle stock holdings. He owns multiple properties, yachts, and a Hawaiian island. He funds this lifestyle largely through loans secured by stock, not by selling stock and paying taxes. Steve Ballmer, former Microsoft CEO, has used similar strategies. Their taxable income in some years has been surprisingly low relative to their net worth because their spending comes from borrowed money, not income. The interest payments are often tax deductible, creating a second benefit. If you borrow $100 million at 3% interest, you pay $3 million annually. If that interest is deductible against other income, it reduces your tax burden. You're using pre-tax dollars to pay interest on money you're spending tax-free. The math gets even better if your stock appreciates faster than the interest rate. Borrow at 3%, stock appreciates at 10%, you're ahead 7% annually while paying no capital gains tax. Banks love this business. Lending to billionaires secured by blue-chip stocks is low risk and profitable. The default risk is minimal because the collateral is liquid and valuable. If the borrower doesn't pay, the bank seizes the stock and sells it immediately to recover the loan. Interest rates are low, but volume is high, and these relationships often lead to other lucrative business: wealth management, estate planning, corporate banking. The Federal Reserve's low interest rate policies from 2008 to 2021 made this strategy even more attractive. When the Fed funds rate was near zero, banks could borrow cheaply and lend to wealthy individuals at 2 to 3%. The spread was profitable for banks, and the cost was trivial for borrowers. Billionaires effectively financed their lifestyles at near zero real cost while their stock holdings appreciated 10 to 20% annually. This creates a wealth snowball effect. Your assets appreciate 10% annually. You borrow 3% of your assets' value to spend. Your net wealth still increases 7% annually, compounding over time. You're getting wealthier while spending lavishly and paying zero capital gains tax. Middle-class wage earners see their income taxed immediately, save what's left, and try to build wealth slowly. The wealthy build wealth through untaxed appreciation while spending borrowed money tax-free. The third step, die, is where the strategy becomes generational. Under U.S. tax law, when you die, your heirs receive assets at a stepped-up basis. The cost basis resets to the fair market value at the date of death. All unrealized gains are forgiven. No capital gains tax is ever owed on appreciation that occurred during your lifetime. Here's the mechanism. You bought Amazon stock in 1997 for $1 per share. Today, it's worth $3,000 per share. You die owning 1 million shares. Your cost basis was $1 million. The current value is $3 billion. Unrealized gain, $2.999 billion. Under step-up basis rules, your heirs receive the stock with a new cost basis of $3 billion. The value at your death. If they sell immediately, they owe zero capital gains tax because their basis equals the sale price. The step-up basis eliminates the entire tax liability on all appreciation during your lifetime. You never paid capital gains tax because you never sold. Your heirs don't pay capital gains tax because their basis was stepped up. The $2.999 billion in gains are never taxed by anyone. This is perfectly legal and benefits wealthy families enormously. The estate tax is supposed to capture some of this wealth at death, but it's easily avoided. The estate tax exemption is currently $13.61 million per person, $27.22 million per married couple, indexed for inflation. Only estates exceeding this amount owe estate tax. The rate is 40% on amounts above the exemption. But wealthy families use trusts, gifting strategies, charitable donations, and valuation techniques to minimize or eliminate estate tax. Grantor-retained annuity trusts, GRATs, intentionally defective grantor trusts, IDGTs, dynasty trusts, and other structures allow transferring wealth to heirs while minimizing taxes. Assets can be gifted during life up to the lifetime exemption amount. Charitable foundations can hold assets, provide family income, and reduce estate size. Valuation discounts for family businesses or illiquid assets reduce taxable estate value. Wealthy families employ teams of estate attorneys and accountants to structure transfers tax efficiently. The result is that many billionaire estates pay minimal estate tax. When David Koch died in 2019 with an estimated $50 billion fortune, his estate likely used trusts and other mechanisms to reduce estate tax. Sheldon Adelson's estate, estimated at $35 billion, similarly used legal strategies to minimize taxes. The nominal estate tax rate is 40%, but the effective rate for sophisticated estates is often single digits or even zero. When the London gold pool closed in March 1968, there was no warning. Investors woke up and the market was locked. No gold available, no conversion, done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse, before banks freeze, before governments confiscate, before inflation devours your savings. While you can still act, combining buy, borrow, die creates a perpetual tax avoidance machine. Buy assets that appreciate. Borrow against them to fund lifestyle. Die and pass assets with stepped-up basis to heirs. Heirs repeat the cycle. Generational wealth compounds while avoiding capital gains taxes indefinitely. The ProPublica investigation in 2021 revealed the scale of this strategy. Analyzing IRS data for the wealthiest Americans, they found that billionaires' wealth increased by $1.1 trillion from 2014 to 2018. But they paid only $13.6 billion in federal income taxes, an effective tax rate of 1.2%. How? Most of their wealth growth was unrealized capital gains, untaxed until sold. Jeff Bezos' wealth increased by $99 billion from 2014 to 2018. He reported $4.22 billion in income and paid $973 million in federal income tax, a 23% rate on reported income, but only 1% relative to his wealth growth. The difference is unrealized gains in Amazon stock, which aren't taxed. Elon Musk's wealth increased by $13.9 billion from 2014 to 2018. He reported $1.52 billion in income and paid $455 million in taxes, a 30% rate on income, but 3.3% relative to wealth growth. Again, most wealth growth was untaxed Tesla stock appreciation. Warren Buffett's wealth increased by $24.3 billion from 2014 to 2018. He reported $125 million in income and paid $23.7 million in taxes, a 19% rate on income, but 0.1% relative to wealth growth. Buffett has acknowledged this disparity, famously noting that his secretary pays a higher tax rate than he does. The disparity between wealth growth and taxes paid demonstrates buy, borrow, die in action. The wealthy build wealth through asset appreciation, which isn't taxed until realized. They fund lifestyles through borrowing, which isn't taxed. They pass wealth to heirs with stepped-up basis, eliminating tax obligations. The system allows accumulating and transferring billions while paying minimal taxes. Compare this to how wage earners experience taxation. A software engineer earning $200,000 annually pays roughly $50,000 in federal income tax, $15,000 in Social Security and Medicare taxes, and potentially $20,000 in state taxes. Total tax burden, $85,000 or 42.5% of income. The engineer receives $115,000 after taxes to live on and save. If that engineer saves $30,000 annually and invests it, those savings came from after-tax income. The $30,000 was part of the $115,000 remaining after paying $85,000 in taxes. When the investments appreciate and the engineer eventually sells, they pay capital gains tax again, though at lower rates than income tax. This is the double taxation that wage earners face: income tax when earned, capital gains tax when investments are sold. Now compare to a billionaire whose wealth increases $1 billion in a year through stock appreciation. They pay zero tax on that $1 billion gain unless they sell. They borrow $50 million against the appreciated stock at 3% interest to fund their lifestyle. The $50 million is tax-free because loan proceeds aren't income. They pay $1.5 million in interest, which may be tax-deductible. Their effective tax rate on $1 billion in wealth increased zero. Their spendable cash, $50 million, tax-free. The engineer paid 42.5% tax on $200,000 and has $115,000 to spend. The billionaire paid 0% tax on $1 billion and has $50 million to spend borrowed tax-free. Both are following the law. The system just treats them completely differently. The legal basis for step-up basis dates to the 1921 Revenue Act. The rationale was administrative simplicity. Tracking cost basis for assets held for decades was difficult in an era of paper records. The policy also reflected a view that taxing appreciation at death would be double taxation if estate tax is applied. But estate tax exemptions have grown so large that most estates avoid estate tax, meaning appreciation escapes taxation entirely. Congress has periodically considered eliminating step-up basis. The Obama administration proposed taxing unrealized gains at death as if assets were sold. Biden's 2021 tax proposal included a similar provision for estates over $1 million, with higher exemptions for certain assets. But these proposals face political opposition from wealthy donors and arguments that taxing unrealized gains is administratively complex or constitutionally questionable. The alternative to step-up basis would be carryover basis. Heirs receive assets at the deceased's original cost basis. If you bought Amazon at $1 and it's worth $3,000 at death, your heirs receive it with a $1 basis. When they sell, they owe capital gains tax on the full $2,999 appreciation. This would close the loophole but requires tracking cost basis across generations and could create liquidity issues if heirs inherit appreciated assets but lack cash to pay taxes. Opponents argue that eliminating step-up basis would harm family farms and small businesses. A farm passed through generations might have appreciated enormously, creating huge tax bills when the owner dies. Heirs might need to sell the farm to pay taxes, breaking up multi-generational family businesses. Proponents counter that exemptions could protect small estates while eliminating the benefit for billionaires. The political reality is that changing step-up basis is difficult. Wealthy individuals and families have strong incentives to preserve it and resources to lobby for its continuation. The estate planning industry, attorneys, accountants, wealth advisors, benefits from the complexity that step-up basis and estate tax planning create. Middle-class voters may support step-up basis because they aspire to leave homes or small businesses to children without tax complications. The concentration of wealth facilitated by buy, borrow, die has societal implications. When the wealthiest can accumulate billions while paying minimal taxes, government revenue depends increasingly on wage earners and smaller businesses. The Tax Foundation estimates that the top 1% paid 42.3% of all federal income taxes in 2020, but this doesn't account for untaxed wealth accumulation through unrealized gains. If wealth inequality continues growing and the wealthy continue avoiding taxes on their primary source of wealth, asset appreciation, the tax burden shifts to wage earners who can't use these strategies. A teacher earning $60,000 pays income tax on every dollar. A billionaire with $10 billion in stock appreciation pays zero tax on those gains unless they sell. The system creates different tax realities for different classes. The fiscal implications are significant. If unrealized gains were taxed annually or at death, federal revenue would increase substantially. Estimates vary, but eliminating step-up basis alone could generate $40 to $60 billion annually. Taxing unrealized gains above certain thresholds could raise hundreds of billions. This revenue could fund programs, reduce deficits, or lower taxes on wage earners. But implementing such changes is technically and politically challenging. Unrealized gains fluctuate. Tesla stock might be worth $300 billion this year and $200 billion next year. Taxing unrealized gains creates liquidity problems. How do you pay tax on gains you haven't converted to cash? Do you force asset sales? What happens if assets decline after you paid tax on higher values? Some proposals address these challenges. Senator Ron Wyden proposed a billionaire minimum income tax that would treat tradable assets as sold annually, taxing unrealized gains for individuals with over $100 million in wealth. Taxpayers could defer payment but would owe interest, creating an incentive to pay currently or sell assets to cover taxes. This would eliminate the buy and die benefits but faces constitutional questions about whether unrealized gains are income under the 16th Amendment. Alternative approaches include wealth taxes rather than income taxes. France, Norway, Spain, and Switzerland have wealth taxes on net worth exceeding certain thresholds. Argentina has a one-time wealth tax on fortunes over $2.5 million to fund COVID relief. Wealth taxes avoid the realization problem but create valuation challenges for illiquid assets and enforcement difficulties when wealth is held offshore or in complex structures. The political debate reflects fundamental disagreements about taxation philosophy. Progressives argue that taxing wealth is necessary for equity and revenue. Conservatives argue that wealth taxes are unconstitutional, economically destructive, and difficult to administer. Libertarians argue that all taxation is coercion, but accepting it exists. Taxing realized income is more practical than taxing unrealized wealth. The wealthy argue they already pay the majority of taxes and that their investments create jobs and growth. They note that capital gains are taxed when realized, just deferred. They point out that their wealth is often illiquid and tied up in companies they manage. Forcing asset sales to pay taxes could reduce their control and harm the companies. They suggest that estate taxes, though avoided, still capture some wealth at generational transfer. Critics respond that deferral is the point. Never paying taxes on primary wealth source is different from paying later. The jobs and growth argument doesn't address why appreciation should be untaxed while wages are taxed immediately. Liquidity concerns could be addressed through payment plans or allowing stock transfers to satisfy tax obligations. Estate taxes are avoided by sophisticated planning, so they don't effectively tax dynastic wealth. The question is whether the current system, where wage income is taxed immediately and heavily, But asset appreciation is untaxed until realized and possibly eliminated at death, is equitable and sustainable. The answer depends on values regarding taxation, wealth, and fairness. But the mechanics of buy, borrow, die are clear. It's a legal strategy that allows accumulating and transferring vast wealth while paying minimal taxes. You're participating in an economy where the rules differ by wealth level. If you're a wage earner, you pay taxes on income before you see it. If you're a billionaire, you can accumulate wealth through appreciation, live off borrowed money, and pass assets to heirs tax-free. This isn't a secret or a scam, it's designed into the tax code. Changing it would require political will to challenge powerful interests and solve technical problems of taxing unrealized gains. The buy, borrow, die strategy will continue until the law changes. Billionaires will keep using it because the alternative, selling assets and paying taxes, is economically irrational. Banks will keep facilitating it because lending to the ultra-wealthy is profitable and low risk. The tax code will keep allowing it because changing fundamental taxation principles is politically difficult. And wealth concentration will continue growing as asset appreciation compounds untaxed across generations. This is Decoded Economics. Subscribe to see the collapse before it happens.